Hi, and welcome to QCity Metro. I'm Glenn Burkins. Everywhere you turn these days, talk is in the air of inflation, rising interest rates, and even the possibility that our economy might be heading toward recession. What does it all mean? We're going to unpack that today with our special guest, Jeff Korzenik. Jeff is Chief Investment Strategist for Fifth Third Bank. Before we talk about yesterday's Fed move, let's talk about the economy as a whole. Where do you see the U.S. economy right now?
The U.S. economy has been growing at a reasonable clip in terms of more people are going back to work every month. Consumers are buying more goods. The problem is that inflation has been eroding job gains, eroding real activity to such a degree that actual growth, adjusted for inflation, has been pretty poor.
There is a lot of talk in the air that the economy might be heading toward recession. How does Fifth Third see that? How do you see that?
We still think the base case should be for continued growth, but it's a tough call. And we have recently raised our possibility of a recession from 30% possibility to a 40%. The longer inflation persists, the greater a threat it is to our continued expansion, in part because it requires a response from the Federal Reserve to raise interest rates. And the more that goes on, it becomes kind of a race. What's going to break first, the economy, and meaning a recession, or will inflation get back under control? We're still in the camp that says it's going to be a tough call, but we think inflation will break before the economy.
So yesterday, the Fed did act. The Fed raised its benchmark interest rate 0.75 of a percentage point. What does that all mean?
Well, that means a lot of things. For one, it's a signal that the Fed is getting very, very aggressive in its battle against inflation. In fact, it had been expected to raise interest rates only 0.5% until the CPI report, the Consumer Price Index, that measure of inflation that all of us face in our day-to-day lives, came out with a very bad number, 8.6% inflation compared to year-ago levels. And then a similar wholesale inflation report, actually a larger number, but similar in showing that inflation is not under control. That shifted the Fed into this higher gear, 0.75% rise in the short-term interest rates they control. I would mention this is the first rate hike of that size since 1994, so it's very, very significant. What it means to consumers is that if you have floating rate debt, which means credit card debt, or an adjustable rate mortgage, most people have fixed rate mortgages, but adjustable rate mortgages, all those interest rates are going up and will be felt. The burden of carrying that kind of debt goes higher. There's a second impact, and that's that these higher interest rates tend to slow the economy and create a greater risk of a recession.
So what advice would you give to people who might be carrying credit card debt, student loans, the types of debt that might be most impacted by the Fed's decision?
Obviously, to the degree individuals have the ability to pay that down and lessen their exposure, that makes a lot of sense in a rising rate, because this is not likely to be the Fed's last increase of interest rates. The Fed itself expects to be on a trajectory of a couple full percent more of interest rate hikes. That's going to be felt if you carry a lot of debt. I mean, we're fortunate in the country right now that debt burdens are pretty low, but that's not true for every single person.
We know that higher interest rates increase the cost of borrowing. That it impacts people who are carrying debt. Do higher interest rates have other hidden impacts that consumers will feel?
In some can be positive also. It seems to be already cooling off the housing market a little bit because it's caused mortgage interest rates to go up. And so new buyers are faced with higher interest rates, but maybe the cost of housing might cool off a little bit, or at least not rise as dramatically. That's probably more relevant to helping cool off rental markets as well. As we know, rents have been just skyrocketing higher. And one hope for consumers is that a little bit slower pace of everything in the economy because of higher interest rates might start cooling some of that off. It's not a clear-cut case one way or another. By and large, higher interest rates are bad news for consumers, except if it is successful and fights inflation. We've got to get inflation under control. It's eroding everyone's paycheck, higher food prices, higher gasoline prices. We've seen higher car prices, particularly used car prices. All of this has really hurt people quite a bit. And our hope and our belief is that the Fed will ultimately be successful and that we'll start to cool off this hot inflation.
Businesses borrow money too. And so could that actually impact consumer prices if a company has to borrow more money or has to borrow money? Could that impact what we see at grocery stores in any way?
In a sense that higher borrowing costs for corporations could be passed on to consumers, but the net effect, right? There's some things that support more inflation, higher borrowing costs for certain corporations, but the net effect tends to be to lower cost inflation to consumers. Doesn't mean we're going backwards in prices, but it means we'll stop going up and up and up in prices.
One of the things we've seen for a very long time now is very low interest rates on bank deposits. Bank deposits have been, or interest on bank deposits have been less than 1% now for a while. Are we going to see banks paying more for on savings accounts, certificates of deposits, things like that?
It's already starting to inch up. I would think in this cycle, just given the dynamics of this cycle, it won't go up terribly dramatically, but you'll start to see a higher return. Where people are seeing significantly higher returns are things like bond yields. So people who are able to invest for the longer term and buy even treasury bond yields can get a better than a 3% return going out 10 years now. That's something that we haven't seen for many years. And so those are some opportunities, perhaps not so much for savers, people who only use deposits or short-term CDs, but for investors who can go out a little bit longer and take those risks.
So your general advice to consumers would be, if you can afford to pay down debt, eliminate debt, especially credit card debt, the types of debt that are directly impacted by higher interest rates, they should take this opportunity to do so.
They should do that. And in a broader sense, although our base case at Fifth Third is that we will avoid this recession, it's a distinct possibility. And there's a degree to which consumers should always have some kind of cash reserve and emergency fund if they can afford to build that up. I think that's very important right now, as well as for small businesses to have a little bit. Don't expect a recession, but be prepared for one if it does turn in that direction.
And what does that reserve look like? Is there a
the rule of thumb you often hear is 6 months of living expenses in cash or something that can be quickly converted to cash. There's also, people can approach this in different ways. For retirees, it might be a greater amount of money if they're living off of investments and you don't want to have to tap those investments in a market downturn. So having a larger cash reserve can be important. It really depends very much on individual circumstances. If retirees, say, are living off of pensions and those pensions have cost of living adjustments already, they tend to be pretty protected in environments like this.
Final question, Jeff. Speaking of retirees, how is this going to impact our retirement accounts, our 401ks, our pension plan, our pension plans, even our private investments in stocks and bonds? What impact is this going to have?
Well, it's already had a substantial impact. We are in technically a bear market, meaning that the S&P 500 index, which is a measure of the performance of the 500 largest companies in the United States that are publicly traded, has declined more than 20%. That's the definition of a bear market. Sometimes bear markets predict recession, sometimes they don't. So people have already felt that pain. And unlike some of more recent cycles, there was no hiding in bonds. A lot of people have diversified portfolios. In many periods, bonds go up when stocks go down and vice versa. So you have some kind of balance. This has been a tough environment for investors because stocks have gone down and by and large, bonds have gone down as well. So we're already feeling that pain. However, it's really important to remember that the secret to successful investing, to meeting your life goals, is having discipline, and that is, in our view, evidenced by having a diversified, thoughtful portfolio and patience. And only investors can really provide that patience. But it's important to look out to the long term, realize the economy over time grows, even if you do have short-term setbacks, and that ultimately benefits patient investors.
So in other words, don't panic over the short term.
That's correct.
Thank you, Jeff.
Thank you so much, Glenn, and thanks to all your listeners and viewers.
All right, have a good day.
Thank you.